As of the close of the regular U.S. market session on June 18, 2026 at 4:01 p.m. Eastern Daylight Time, the market is officially closed, and Nokia OYJ, trading under the ticker symbol NOK on the New York Stock Exchange, finished the day at $13.49, representing an intraday drop of 2.46% from its previous close of $13.83. While standard market participants look at a daily decline like this and assume a legacy technology brand is simply fading into structural irrelevance, the underlying realities of this price action reveal something far more compelling that traditional screens completely miss. The broader market narrative operates under the heavy expectation that this company is a stagnant relic of mobile phones past, a slow-moving utility trapped in low-margin hardware cycles. But the reality breaking through the tape is a multi-month accumulation cycle that has quietly propelled this equity up more than 100% from its late February lows of $7.57 to a recent peak exceeding $16. This massive valuation re-rating is not being driven by speculative retail hype, but by a foundational shift in how global defense networks, private enterprise architectures, and cloud providers view secure connectivity. When a legacy hardware player suddenly transforms into the literal nervous system of secure battlefield communications and open radio access infrastructure, the old valuation models break completely, leaving under-hedged institutional positions scrambling to adjust their capital allocations before the next major macro leg. To understand the sheer magnitude of the current trading environment, we have to look closely at the recent daily swings and institutional block activity that have characterized the past month. During the peak of the rally in late May and early June, trading volumes skyrocketed to over 125 million shares in a single session, a massive departure from the historical baseline liquidity for this asset. This intense volume signature indicates aggressive institutional accumulation rather than simple retail speculation. When capital flows this rapidly into an individual brokerage or across major desks at entities like Fidelity Investments, it usually signals that structural allocators are reassessing their long-term sector weightings. Over the past week, we saw a healthy technical drawdown of roughly 11% from the local highs, as short-term traders executing orders via the Robinhood app took profits, flushing out weak hands and cooling off the overbought daily relative strength indicators. This consolidation near $13.49 is a classic textbook retest of previous resistance lines, presenting a structural battleground between retail options traders on Robinhood stock trading platforms who fear the rally is finished, and macro funds using an interactive broker's account to absorb every block of floating supply. This visible friction between different classes of market participants highlights the growing popularity of self-investing and the changing mechanics of modern online investing sites. Investors who rely on simple automated platforms such as Schwab Intelligent Portfolios or basic robo-allocators often find themselves underweighted in international industrial tech because their algorithms look backward at trailing 5-year earnings metrics. In contrast, active managers utilizing specialized interactive broker stock trading tools are closely watching the shifting dynamics of global data infrastructure. While retail cash management accounts on platforms like Robinhood Crypto and Robinhood Investments are heavily concentrated in hypergrowth megataps like Nvidia stock or Tesla stock, sophisticated capital is looking for a margin of safety. They are finding it in asset classes that trade at steep discounts to replacement value, while simultaneously picking up high-margin market share in critical infrastructure sectors. The sudden explosion of institutional volume on the Fidelity trading platform for asset classes tied to hardware infrastructure proves that when capital seeks a haven from premium valuations elsewhere, the unloved cash-generating giants become highly attractive targets. This brings us to the recent fundamental catalysts that are forcing a massive rethink of the company's trajectory. Just hours ago, news broke of a major partnership between Nokia's Specialized Defense Unit and KNDS to supply advanced battlefield connectivity systems for frontline troops and autonomous unmanned platforms. This is a massive structural departure from simply selling base stations to consumer wireless carriers. By establishing a presence in tactical military networks, the company is capturing sticky, high-margin government defense budgets that are completely insulated from typical consumer economic downturns. This sector momentum comes at a time when macroeconomic pressures, persistent global interest rate fluctuations, and corporate software spend rationalizations are causing significant volatility across major tech names. When premium growth stocks like Apple stock face regulatory hurdles or saturation headwinds, fund managers routinely rotate capital into undervalued cash flow stories. Tracing the order flow across specialized interactive brokers fee structures and large block trades on the Fidelity brokerage desk reveals that smart money is quietly treating this business as a defensive hedge wrapped inside a high-bandwidth infrastructure growth play. Now let's establish common ground on what this business actually is today, separating its modern commercial reality from historical consumer nostalgia.
For decades, the public associated this brand with consumer handsets, but that entire architecture was completely dismantled and sold off years ago. Today, the corporation operates as a pure-play telecommunications and data network vendor, structured around mobile networks, network infrastructure, and a highly lucrative cloud and network services portfolio. They build the routers, the switches, the optical submarine cables, and the cloud-native software layers that allow the global internet to function securely. Looking back at past performance, the asset has a deep 32-year public trading history on the New York Stock Exchange, peaking at an all-time high of $29.53 during the market bubble of 2000, before enduring a prolonged multi-decade restructuring phase. Today, with a market capitalization stabilizing around $78 billion and an elevated trailing price-to-earnings ratio caused by near-term restructuring outlays, the underlying corporate engine is leaner and significantly more profitable than it has been at any point over the last decade. Comment below how many shares of Nokia stock you currently hold in your portfolio, or tell me if you are actively avoiding legacy telecom hardware in favor of high-growth software models. Looking ahead toward the future outlook, the core investment thesis will continue to be defined by the intense tension between widespread market skepticism and the emerging operational reality. If you open a standard individual brokerage account or scan popular online investment forums, you will find that the prevailing narrative remains intensely skeptical, pointing to historical capital expenditure fatigue among major telecom operators who have slowed down their hardware orders. This expectation of flatline growth is precisely what keeps the current valuation multiple compressed compared to the broader technology sector. However, the reality shifting underneath this sentiment is the mandatory, non-discretionary requirement for sovereign security networks, data center interconnects, and hardened corporate intranets. As automated systems scale globally, the sheer volume of data moving across networks requires physical optical fiber and advanced routing chips that cannot be replicated by software alone. There are distinct future scenarios that investors must actively prepare for over the coming quarters. In a bullish scenario, the expansion of high-margin software licenses combined with extended defense contracts across the Western Alliance could drive structural operating margins well past historical thresholds, sparking a sustained valuation breakout toward the high teens. Conversely, the primary risk scenario involves a deeper macroeconomic slowdown that forces commercial carriers to delay necessary equipment upgrades, stalling recent top-line expansion and leaving the stock vulnerable to a prolonged consolidation pattern around its key support zones. For self-directed allocators managing their capital via SoFi Investing, Fidelity IRAs, or advanced interactive brokers platform applications, navigating this landscape requires looking past superficial daily price movements. The true narrative is written in the multi-billion-dollar backlog of infrastructure deals, the steady monetization of an immense global patent portfolio, and the ongoing accumulation of physical network assets by large-scale institutional managers. Ultimately, the lesson of this current market cycle is that the gap between corporate public perception and actual balance sheet performance creates the most significant dislocations in the equity markets. When the broader investing public views an asset through the lens of obsolete history, they leave the door wide open for institutional allocators to step in and capture structural value at a deep discount. Whether you manage your personal wealth through a comprehensive suite like Fidelity Wealth Management, execute short-term swings using the convenience of the SoFi trading platform, or rely on the systematic rules of a SoFi robo-advisor, the core discipline remains identical. You must separate long-term fundamental accumulation from short-term retail noise, ensuring that your portfolio positioning aligns with structural cash generation rather than outdated market sentiment. The quiet transformation of this enterprise from an old-school mobile phone company into a critical defense and data infrastructure giant underscores a profound reality that the market is only just beginning to price in, making it one of the most intriguing structural turnarounds currently printing on the tape.